Good afternoon, everyone, and thank you for your patience there as we were working through some last-minute technical difficulties. But thank you so much for joining us today for what I believe will be a crucial, important hour you'll spend this year thinking about your business. By way of introduction, my name is Billy Wall. I'm the head of growth here at Ascentium Australia, which is part of the InCorp Advisory Group. For those who don't know who we are, we work closely with Australian C-suites and global leadership teams to navigate complex regulatory transformations across the APAC region. Today's topic, which is around the Australian ESG landscape, isn't just another compliance webinar. What we're witnessing right now in 2025 through to 2027 is one of the most significant shifts in corporate accountability for climate and ESG matters in Australia's history. I think we're moving from a world where ESG was voluntary, where companies could choose whether to participate, to a world where it's mandatory, legally enforceable, and carries personal liability for directors. So if you're a CFO, CEO, company secretary, board director of an Australian entity, especially those that are tipping with revenue over 50 million, what we cover in the next hour could save you from regulatory penalties, reputational damage, and missed market opportunities. So we've assembled an expert panel today to give you not just the what and why, but the how, the practical, actionable guidance you can take back to your teams immediately. Before we get into those technical details, I want to ground us in the reality of what's happening in the market right now. These are not hypothetical scenarios. These are actual headlines from recent months. What you're seeing here, Nemrata, if we could go to the next slide, is major corporations facing regulatory scrutiny over climate disclosures. We're seeing investors demanding transparency on ESG risks. We're seeing first mover companies already publishing their AASB S2 reports. And ASIC is signaling that enforcement is a priority, not an aspiration. The tone from the regulators has shifted dramatically. This isn't just guidance anymore, it's enforcement. And ASIC has made it absolutely clear misleading climate disclosures will be pursued with the same vigor as a misleading financial statement. And here's what's absolutely critical. Your stakeholders are watching. Your investors are comparing you to your peers. Your customers are asking questions. Your best talent, especially the younger professionals, want to work for companies that take this seriously. And the companies getting ahead of this are turning compliance into a competitive advantage. The companies waiting are accumulating risk. So the question isn't, should we do ESG? The question is, how do we do it right? How do we do it efficiently and in a way that creates value? The Australian Financial Review has been tracking this transformation very closely and for absolutely a good reason. It's fundamentally reshaping how Australian businesses operate. What you're seeing in the AFR and other major business publications is that ESG disclosure has moved from the CSR section to the front page. It's now a boardroom priority, a conversation, a CFO responsibility, and an investor relations imperative. Major Australian corporates, your peers, your competitors are already deep into their first disclosure cycles. Some are setting the bar really high, demonstrating climate leadership and attracting capital, and others are struggling and facing criticism for the inadequate disclosure. And the market is watching, the media is amplifying, and your first sustainability report will be scrutinized, compared, and potentially criticized if it falls short. This media attention underscores something crucial. ESG performance and disclosure quality are now integral to your corporate reputation and your market positioning. So without further ado, let me introduce you to our expert panel who will guide you through this transformation. I'm hosting today and facilitating, bringing somewhat of a perspective from working with dozens of Australian C-level companies navigating that regulatory complexity across multiple markets. Nemrata Motaramani here is our manager of ESG practices at Ascentium. Nemrata brings 6 years of international sustainability experience across India and Europe with deep expertise in ESG strategy consulting, SDG compliance, and renewable energy. She holds a master's in global business and sustainability from the Netherlands, which gives a unique lens on how the global frameworks like IFRS S2 translate into the Australian requirements under AASB 2. NetNada has been in the trenches helping companies build materiality assessments, conducting climate scenario analysis, and calculating Scope 3 emissions, preparing for independent assurance. She understands both the regulatory requirements and the practical realities of implementation. Joining us as well is Afonso Fermo, co-founder and co-CEO of NetNada. Afonso's background is in business sustainability and supports medium and large organizations meeting climate and sustainability reporting obligations, supporting alignment with CSRD, CDP, SBTI, and AASB frameworks, and a former sustainability consultant who built NetNada to automate reporting and simplify AASB S2 compliance for Australian businesses. Someone I've had the pleasure of getting to know over the last few weeks, and I can see his absolute passion for helping this space and helping business navigate this complex landscape. So without further ado, over to the both of you, and NetNada, take it away. Thank you.
Thank you, Billy. Thank you for the introduction and setting up the context so well. So I think let's dive into today's agenda, what we are going to talk about, and kind of the technical heart of Australia's ESG transformation. Over the next 30 to 35 minutes, I'll walk you through 6 critical areas. First, we'll be establishing a clear understanding of Australia's ESG regulatory transformation, why this matters, and what has fundamentally changed. Second, we will do a deep dive into AASB S2 climate-related disclosures, the 4 pillars on which it's based. Then third, I'll give you a practical implementation roadmap. It is a simple, proven 5-step approach, how you can go from baseline assessment all the way through to reporting and assurance. Fourth, we'll be exploring the broader ESG landscape, like beyond the climate disclosures, what all is necessary, what all is happening right now, what are the best practices emerging in Australia. Then we'll discuss how you can build capabilities and how you can leverage technology to streamline the compliance for your company. And finally, Afonso here, he'll be demonstrating ESG ROI calculator, and he'll show you how to quantify the business case. Throughout this session, please feel free to drop in your questions in the question and answer function, and in the end, we will be answering all the questions. Thank you. So here we go. This slide kind of captures the fundamental shift that's happening right now. And I know Billy has already talked about it, but I just cannot overstate its significance. So for decades, ESG reporting in Australia was voluntary. Companies could choose whether to participate in the frameworks, and it was driven mostly by stakeholder pressure or investor request or corporate values. But more or less, it was optional. But that era is over now. So 2025 to 2027 is representing the most significant shift in corporate accountability for climate and ESG matters in the history of Australia as of now. So we are moving from voluntary ESG frameworks to mandatory compliance along with legal consequences. So yeah, let me be very specific about what it means. You have legal obligation. There are civil penalties that are coming up. So this is a regulatory revolution happening right now, and your board needs to understand that climate disclosure is now a legal duty with the same gravity, as Billy already mentioned, as financial reporting. So yeah, this is just, I wanted to kind of reinstate the, yeah. And I think I'll also talk about the 4 factors which are kind of driving this change. First one is domestic regulation, of course. Australia is implementing the mandatory disclosure regime. So that is one. Then it is global alignment. So Australia is adopting IFRS S1, S2, which is a global standard, and it is accepted in over 30 jurisdictions as of now. So which means that it's no longer operating in isolation. We are a part of interconnected global framework. Then third is the capital markets pressure, of course. So a lot of green investment, as we call it, bonds, as we call it. So a lot of ESG investment is happening. It has surged to around 157. There is this, 157 billion Australian dollar as we speak, which is, as per a report, 8 times increase from just 20 billion in 2020. So this is a big amount which should catch the attention of CFOs. And lastly, of course, stakeholder expectation is not just about regulators and investors. Your employees are wanting this. Your customers are increasingly wanting this. Your supply chain partners, if you are selling to multinationals, are already requiring you to do some ratings and some ESG performance data analysis. So it's a multi-stakeholder mandate. And yeah, this is something that is driving this change as of now. I will also quickly, I know that acronyms can be a little bit overwhelming. So I will just try to quickly trace the lineage of these standards to understand better why they matter. So starting with TCFD, which was a task force on climate-related financial disclosures. It was established in 2015, and later it's kind of the base for what is following right now. So it had 4 pillars. It was kind of disbanded in 2023, after, of course, having achieved its mission. And then came the IFRS Foundation. So it is the International Financial Reporting Standards Foundation, which is responsible for global accounting standards. It recognized the need of sustainability disclosure standards. And so at COP26 in 2021, the International Sustainability Standards Board, which is ISSB, was created within the IFRS Foundation to develop a detailed and mandatory standards. So they released IFRS S1, which is general sustainability disclosures, and IFRS S2, which are climate specific, which are kind of based on TCFD. So this is the order that kind of followed. And now Australian Accounting Standards Board, which is AASB, it took IFRS S1 and S2 and adapted them for the Australian context, creating AASB S1 and S2 as we know them now. So this lineage kind of matters because it shows that Australian standards aren't invented in isolation. They are globally harmonized, which facilitates international investment and comparability for the companies operating in Australia. So after having set up this base, I'll also quickly talk about some Australian features that are involved. So at this point, the S1 is voluntary, but S2 is mandatory. So this is based on the Australian specific regulations. And then the scenario analysis is a bit different. It should compulsorily include a 1.5 degree Celsius pathway. So while IFRS doesn't specify which scenario to include, but Australia specifies, and they mandate a minimum of 2 climate scenarios. So this is specific to Australia. Also, it is embedding these requirements into the Corporations Act, giving ASIC the direct enforcement powers. So these are some Australia-specific criteria of the regulations. So now I would rather kind of jump into the phased implementation plan. It's a good news that it's not a big bang implementation, as we can call it. This is kind of phased in 3 groups based on your company size and your emissions. So group 1, the reporting period is starting for financial years on or after 1st of January 2025. And these are Australia's largest entities. So this means that data collection has already started. And if you are in this category and if you haven't begun, then yes, you are a bit behind. Group 2 are the mid-sized entities. And they will be following. For group 3, they are all the smaller entities. So just a quick timing note that your first report will cover the financial year from your compliance start date. So if you are a December year-end group 1 entity, you have been collecting data since January 1, 2025, and your first report is due March 31, 2026, which is just a few weeks away. And if you are a June 30 year-end entity in Group 1, then your first report is due on September 2026. So yeah, check which group you are into and mark the deadlines because they are non-negotiable. Next, I'll talk about the 4 main pillars of the mandatory AASB S2 disclosure. So these are 4 interconnected pillars. The first one is governance. It's about how your board oversees the climate-related risks. What is your management's role? This kind of establishes the accountability at the highest level. So this is the first pillar. Second pillar is what are your material climate risks and opportunities? How resilient your strategies are across different climate futures, across the different climate scenarios. So this is where the scenario analysis comes into picture. Then the third pillar is risk management. What processes do you use to identify, access, and prioritize the climate risks? How do you manage them? So this talks about how the risk management is integrated with your overall strategy, kind of. And the fourth pillar is the metrics and the targets. So this is the quantitative part. So what are your greenhouse gas emissions across scope 1, 2, and 3? What are the targets that you have set? How are you performing against those targets? So these are the main 4 pillars modeled kind of directly on TCFD. So if you have done TCFD in the past, maybe voluntarily, then you get a head start already. And if not, don't worry, we'll be breaking down each pillar a little bit more in detail. So hope it helps. This is the first.
Just want to add
Yes,
want to add something there.
Yes.
One thing with the just the different timings of different companies reporting.
Yeah.
One quick benefit of being a group 2 company and group 3 company is being able to look at the outcome of other organizations. So keeping in mind at what time different organizations are releasing their reports allows your executives or your board to really compare and see what is the ambition level of different organizations. So make sure that you use those dates not only as my time will come in a year or 2 years, but instead to look at what good looks like and take inspiration from that. That's one really good tip we have for our clients. They are in the group 2 or group 3 companies as they engage their consultants to help with their work.
Yes. Yeah, this is a very good insight, Alfonso. Thank you. I'm sure whoever is listening, they would get a little bit of relief. I think I am trying to stress you a bit. And yeah, thank you for the tip, Alfonso. So, all right, I'll go ahead with discussing the pillars a little bit in detail. So, pillar 1 is about demonstrating the board level accountability for climate risks. And you must be disclosing the board bodies responsible for climate oversight. So, example, our audit and risk committee is chaired by so-and-so independent director, and it reviews the climate risks quarterly and reports to the full board and biannually or something. So this can be an example. Then you have to show the management's role in assessment and monitoring. Who is in the executive team? Who owns the climate risk? How do they access and prioritize risks? So what resources do they have? Example, our chief sustainability officer reporting to the CFO leads a cross-functional climate task force, including representatives from different teams like operations, supply chain, etc. This can be an example. Then the third, it is to show integration into organizational processes. How is climate integrated into strategy, into planning, capital allocation, and for example, you can say that 20% of the executive bonuses are tied to achieving emission reduction targets. So this can be linked to executive compensation. This can be an example. So this is the first pillar. And the key message here is that ASIC wants to see that climate oversight sits at the highest governance level. It's not just buried in some CSR team or some ESG team. And the board's minutes should reflect regular climate risk discussions. So this is the key message across the first pillar. Then we come to pillar 2. It is the heart of your disclosures. This is where you identify and explain your material climate risks and opportunities as well. So we talk about physical risks here. These are the direct impacts of climate change on your business. Then we talk about acute events. We talk about chronic changes. We talk about transition risks. So, of course, it's a lot in depth. We are talking about transition risks. We are talking about policy risks. So basically, we are talking about risks and opportunities throughout your business, which arise from the climate change in whichever scenario. Then we are also talking about opportunities. We are talking about opportunities of new products or services that you can think in maybe renewable energy sector, maybe climate adaptation solutions. So we are also talking about access to new markets. For example, if you talk about green bonds or ESG focused investors, then you get more investment, you can get access to new markets. And finally, we want to talk about the effects on business model, value chain, strategy, and we want to talk about the effect across all time frames, maybe short-term, medium-term, long-term horizons. So this is the part where you talk about all your risks and opportunities. And just to dive in a little bit deeper into the climate scenario analysis, this kind of is seen as the most challenging requirement, but do not worry, it is you have resources out there. It is not so difficult. It's not rocket science. It is essentially a structured way to just test how your strategies will perform under different plausible climate futures. So it's not forecasting, it's exploring what if scenarios essentially. So as per the Australia's mandatory requirement, you must be assessing your strategy using at least 2 scenarios. So one is the low warming scenario, which is 1.5 degree Celsius pathways. And the second is high warming scenario, which is what happens if there is greater than 2 degree Celsius of change. So yeah, these are 2 scenarios that you want to explore. And what you must disclose in the scenario analysis is which scenarios you have used, methodologies, parameters, time horizons, assumptions that you have made, then how these scenarios are affecting your strategy, financial position, and potential performance. So essentially, how resilient is your strategy across both the scenarios? So this is something that you want to demonstrate. And there is a practical tip. So you do not need to invent everything. There are a lot of established scenarios in the IPCC pathway. There are a lot of in the IEA scenarios. So there are some things which you can directly use, and based on that base, you can come up with your analysis. You do not need to invent everything. So yeah, this kind of should just inform your strategic decisions. It shouldn't be a compliance exercise for you. It's helpful for your business after all. So this is how the pillar 2 kind of helps you in the business, not just stresses you out. And I think we can go to the pillar 3, which is risk management. And it focuses on on the processes, not just the outcomes. So of how you manage your climate risk. So under this, you should be disclosing how climate risks are identified and assessed. What methods are you using? Then are you doing materiality assessments? Are you doing stakeholder consultations? So yeah, this is what you need to disclose. Second, you should be deciding which risks matter most to you. So what is your prioritization framework? How do you monitor them over time? For example, you may say, we rank our climate risks using our enterprise risk metrics. So likelihood, cross impact. So maybe you are having some matrices that you use. Then you should be talking about how is this integrated with the overall risk management. So it shouldn't be siloed. You should talk about how it is integrated with financial risk, operational risk, strategic risk. So for example, you can talk about the climate risks are embedded in your enterprise risk register and say they are reviewed alongside other material risks across financial and operational silos. So this is something that you need to think about, disclose. So essentially, ASIC wants to see that climate risk is treated with the same rigor as financial and operational or cyber risk or something. So it's not just an afterthought or a compliance thing, but you have actually put it in your risk register. So this is something that is covered in pillar 3. And now we come to the most important pillar, which is pillar 4, which requires quantitative disclosures of your greenhouse gases. So scope 1, scope 2, scope 3. Scope 1 and scope 2, they are pretty easy, I would say, compared to scope 3. Scope 1 are the direct emissions from your sources, from your which are in your own control. So example, on-site combustion, fuel burned in your company vehicles, etc. Then scope 2 is indirect emissions from purchased energy. It is still fairly simple. Emissions from electricity purchased, steam purchased, heating and cooling that you have paid bills for. So this is also fairly simple. But now comes scope 3, which is, it's a big one. It's all the other indirect emissions in your value chain. So for most companies, scope 3 is kind of 70 to 90% of the total carbon footprint. It covers 15 categories across upstream and downstream activities. So this is kind of a breakdown of the upstream and the downstream categories, 15 categories. And it is challenging because you need data from suppliers, customers, partners, many of whom may not be tracking their emissions yet. So it is a little bit tricky here. So this is why supplier engagement is critical. And this is why actually you are getting the 1-year grace period for scope 3. So of course, we won't go a lot in depth for the categories. So just that there is 1-year delay that you can use because the regulators recognize this is complex. And so it gives you time to engage suppliers, request emission data, build the data collection systems. So just be practical with your approach. You can start with the spend-based method if you want, using the industry averages in the first year. And then you can go ahead trying to get the actual activity-based numbers for scope 3. So yeah, just the message here is that do not waste, as Afonso already mentioned, do not wait for your time to come. So begin early as you can. Begin the supplier engagement as early as you can. And so that you have the data when it becomes the reporting becomes mandatory after 1 year. Yeah. So I can go ahead, but if Afonso, if you want to add something, you can add in.
My only thing that I like to kind of encapsulate all of the work that you've been explaining is that to understand these climate disclosures is less about being sustainable, but more about being resilient. So we have underpinning knowledge that the climate will change. And as that climate changes, a good example is temperature changes, rainfall, disruption in supply chains. The audience, in this case, investors or the government or your consumers, want to understand how your business is going to continue to provide their services as the climate changes. So thinking about how these emissions become impact on your balance sheet, or how they might open new opportunities in the market, and viewing that through that lenses. Also, that scope 3 in a lot of these exercises, the legislation doesn't ask for perfection, they ask you to start. So it's a fantastic way to collaborate with consultants or other providers on building a roadmap and showing control and oversight more than showing like a perfect business. So that's something that we kind of recommend very highly.
Yes, yes. Thank you so much, Afonso. You summed up very nicely all what the companies need to focus on, and that they just need to start rather than being perfect. So thank you, Afonso. So we'll move ahead, and yeah, this is again just kind of a summary of pillar 4. So you have, of course, have to calculate emissions across scope 1, 2, and 3. Then you have to set targets, you have to analyze the performance, and yeah, you just have to check the emission reduction targets. You have to set emission reduction targets, and then you have to see what scopes are included, all the greenhouse gases, or just CO2. So then you have to check the progress against those targets. And you can include other climate-related metrics and targets such as renewable energy percentage targets, water efficiency or water recycling targets. Then if you are in water stressed zone, you might want to focus on that. Say revenue from low carbon products, etc. So these are the targets and performances in pillar 4 that you need to disclose against. Then this is just, of course, you might be knowing this, but just brush up where and how you can report on the sustainability on your sustainability disclosures. So you can either have a separate report, ESG report or sustainability report, standalone document, or you can publish it along with. It should be published on the company website. You can also do it alongside your financial report. So you can have one full annual report with financial as well as non-financial disclosures, and you have to then file it with ASIC. And yeah, the timings are also crucial here. So you have 3 months after your financial year end to publish the report. So it's very similar to the financial report essentially. Then let's talk about, we'll just have a quick glance on the assurance requirements. So this table looks complex, but it's crucial as it shows the phased assurance requirement across different disclosure elements. So to understand this table, there are 2 levels of assurance: limited assurance and reasonable assurance. So as the name suggests, the limited assurance is less extensive testing and lower level of confidence with it, whereas reasonable assurance is it's similar to an audit comprehensive testing with high level of confidence. So it progresses year by year for different groups. So the key takeaway here is, while the first year, of course, is providing some relief, there are no assurances on scenario analysis, risk management, or targets. But you should be still preparing these sections to a high standard, because by year 4, your entire report will be audited to the same standards as your financial reports are being audited right now. So yeah, as we said, that start, of course, you do not need to be perfect, but try to maintain a good standard so that it will help you in future. And who can do it? So it can be conducted by qualified practitioners, typically accounting firms or specialized sustainability assurance providers. So this is the assurance mandate, which is coming up in phased manner. This is the ASIC enforcement and the director liability. So this is where the say the rubber meets the road. So let me be clear, ASIC has regulatory oversight and enforcement powers. I think you saw in some of the news clippings which Billy started with. So these are as similar as your these are going to be as similar as your financial reports, and the penalties can come up. The director's duties extend to climate disclosures, essentially. So they will have personal liability for misleading statements, if any. There can be civil penalties for non-compliance. There can be, so basically the broad takeaway is that your boards needs professional, legal, and sustainability advice. This is the director should ask the management rather that how confident are we that our disclosures are accurate, complete, and defensible. So basically, just treat them as similar as your financial disclosures. They can bring same penalties and same penalties for non-compliance. So, yeah. Critical dates for your business. This is just a drop down from the phased implementation table. So you can just quickly see where you lie. And critical message here is that it's not a 2027 problem or say 2028 problem for many of you. It's a 2026 reality. So if you haven't started preparing yet, you should just start as soon as you can. Having set this base for what it is, how to do it, I think we'll like to jump into a structured 5-step approach, which we have been using. It is pretty top level, or it is pretty kind of high level thing. Of course, there are intermediate steps. There are a lot of small steps that you need to take in the bigger 5-step approach. But just to make it simple for you, we have come up with this structured 5-step approach, and let's walk you through each step. So you can kind of leave today with a clear roadmap in your mind. Of course, it's very high level and it's very basic, but then it will help you. So step 1 will be to conduct baseline assessment. Before you can even start to report, you need to understand what's required and where do you stand. So first, maybe download the standards from the AASB website, read them cover to cover. It's about an 80-page document, the S2 standards, and then understand every disclosure requirement. Assess the AASB Knowledge Hub. There are resources which will provide you guidance, implementation guidance and examples. They also have FAQs, so use them for your benefit. Just get a very good understanding of the standards. Then assess the existing ESG reporting practices. So for example, if you are doing TCFD, or if whatever data collection systems you have in place, what data do you already collect? How do you report? If you report to CDP, or if you're doing any ratings already. So just check where you are standing right now. Do a comprehensive gap analysis, and then so kind of create a checklist that, okay, these are the things needed, already doing this, partially doing this, not doing this. So just create a comprehensive gap analysis checklist, and it kind of becomes your implementation. This gap only becomes your implementation roadmap. So just tick mark all the things that are still to be done. So allow maybe 4 to 6 weeks for a thorough baseline assessment for your company. Then comes step 2, which is based upon the fact that ESG can't be owned by a single person or a team. So it requires governance at the highest level, all the way up to the executives on the ground level. So just ensure active board engagements in ESG oversights. Then designate the ESG committee with a very clear mandate. Assign responsibilities. Train the board members and the employees if needed. So do the executive training, do the operational training, and build capability. And then build strong internal governance structures. So as I said, just define the roles, responsibilities across the organization, and who owns data collection, who reviews the disclosures, etc., etc. Step 3 will be about devising the strategy. Assess your risks, physical as well as transitional climate risks. Have 2 scenarios minimum. Integrate the ESG into business strategy, etc. Then have targets, set measurable targets mainly, and then just disclose them. Step 4 will be to establish data collection systems. Review your existing data collection systems, upgrade them if needed, integrate the ESG data with financial data if you can, whatever data platform that you're using. Implement the scope 1, 2, and 3 tracking mechanisms. This will also help you later for the audit trail. And then ensure the data quality and auditability, as I said. So later on, it will be helpful for you. It will take around 4 to 6 months, ideally, for this process. And lastly, disclose the sustainability information alongside your financial information. Publish the statements, file with SEC, and get it audited so you can build stakeholder trust. This is the last step. So this seems very simple, but yes, of course, you have got some first year reliefs because first year would be very difficult. So there are some reliefs that you can make use of. So for example, scope 3, you don't have to report until in the first year. Then you can also choose to not disclose some commercially sensitive opportunity information if you have any. Also, no assurance is required on certain aspects in the first year. So just use these reliefs to get your first report out, but don't use them as an excuse for not doing work or for low quality disclosures. So build full capabilities from the start because these reliefs are they are just temporary. And by year 4, everything is under reasonable assurance. So think of it as setting a baseline, but make it credible, even if not perfect. Besides the AASB S2, these are some other things which are happening in Australia right now related to ESG. There is this Modern Slavery Act reform. It is mandatory for entities above 100 million Australian dollar they should publish the annual modern slavery statements. So if you are in this bracket, of course, you're already doing it. Then comes the NGER emissions threshold. If you are emitting, there are a couple of thresholds there, facility level and group level. So if you're meeting those targets, you need to report under NGER scheme. Then there is reconciliation action plan. It is not voluntary now as of now, but it is a good practice emerging. Then, some other finance taxonomies, some other nature positive reforms, they are also voluntary and emerging. So I won't go into depth. This is also about ESG ratings. They are happening right now. So there are CDP, MSCI, EcoVadis. If you are, especially if you are in supply chain to any of the multinational companies, then probably you're already seeing this requirement from your customers. I'll not go into depth of all the ESG ratings. And I am actually at the end of my session, and I know you might be feeling overwhelmed, but just to kind of assure you, you're not alone. It looks complex, but it's manageable, the whole ESG implementation thing and the disclosure thing. You can consult experts, you can use technology for simplified compliance if you want. There are proven solutions existing for every challenge. And the companies that start now, build methodically and leverage support will turn compliance into competitive advantage very soon. So just a kind of gist of what solutions are available in the market. You have everything. You can hire experts for everything from adoption strategy, reporting assurance, ratings and certifications, etc., etc. You can help them to build internal capabilities. So do not worry, there are solutions out there. And of course, there is tech out there. So tech tools will be your data backbone. But I would rather give Afonso the stage to talk about tech and then to take you through about the return on investment that you will probably put in building these systems. So yeah, I would hand over to Afonso. Thank you.
Awesome. Fantastic presentation. Thank you so much for the time. One thing that I would like to say is the main difference in terms of using technology, and we are big believers of technology plus advisory coming together, is because the difference between then and now is that what you are doing today needs to be audited. And as audited needs processes. So sometimes spreadsheets can break. A process that is not very well oiled will lead to gaps in methodology. And at the end of the day, it will make it more expensive for you to pay your auditor to find those gaps and having them implemented in the first place. And like you were showing, there is many tools to different parts of this problem out there. Ideally, there'll be in a very near future one tool to serve every problem. But today is about connectivity. It's about how your auditor can use the tool that you use, how your consultant that you hired can collaborate, example templates and worksheets. One thing that I'll make sure to share, but you have available is to share with the audience is examples. Visualizing examples of what sometimes we deal with group 2 and group 3 companies where they don't know what a risk management framework might look like. They never built one. And so showcasing what you build and what you disclose, I think is really, really important. That's really good to see. So I'm going to show two things. Instead of jumping directly into a ROI calculator, I'm actually going to jump into the NetNada system. So the NetNada system is something that we built with a lot of collaboration from consultants, which as an end client will be fantastic to hear because it wasn't built by just tech people, but instead sustainability professionals contributing into climate disclosures. And what we tried to do in the first place is do two things to collaborate, is dividing technology into what will be the very data heavy emissions analysis, but also dividing it into what will be creating your report and the backbone of your disclosures. To help with that, we've actually baked in the legislation into the system, and for every requirement, we've gave you an entry for you to upload evidence of what that is. So if you have done an ISO with a consultant, doesn't matter what that is for security or environmental standards, the process. So if there's a requirement, we link that to the legislation, and we allow you to understand what evidence you need, to upload that, to assign completion dates, review dates. So when you extract all those information for your auditor to review, this process is way seamless. So that's a big advantage of using technology, is to make sure that everything is being collated in the same place, everything has instructions, and everything has comments to build that methodology. And we're also starting to build templates into the system. So with the first reports, you can access what an example of a climate transition plan might look like, and download that evidence or that example to begin. And then on the data gathering, like you were saying, it might take up to 4 months. How do you manage that work over 4 months in collaboration with a consultant that might be helping you out in a team of 2, 3, or 4 within your company? Is to navigate data gathering as a task manager. If you ever use Trello, Asana, Monday.com, you'll be very familiar with this interface. And what you want to do in here is to understand what things you need to gather within your organization, with the different parts of your organization for different periods and different categories, and have everything consolidated in one place. So you're able to understand that you need to find energy, you understand what it is, the due dates, and we have our system review all of the information. So you kind of drag and drop invoices, you import spreadsheets, and the system will analyze all the data for you to visualize, or for your consultant, who might be an expert in this case, to analyze and really understand everything that has been calculated, be able to change and edit, and then download all of that data for your auditor to see. So it's all about collaboration using technology. It's not technology alone that will solve this problem. It's about giving you the infrastructure to do this. If you have any questions on this, of course, I'm sure you'll share this with the audience. but really about collaborating on what the gaps might be. In terms of ROI that we tell all our clients, and I'll change screen here for a second. Let me just share screen again. And I'll come in here. There you go. It's a very simple tool that we've kind of built in collaboration with our clients, really to understand how they gain value from understanding the true cost of climate reporting. And I'll share this with the audience later, like a link directly to this. Is understanding that there is hidden costs about doing this all internally without engaging a consultant or using technology. And one of the main inputs that we have to calculate the ROI of starting this work earlier with software or a consultant is really that thing about competitive advantage, that there is an FTE cost input that has a base salary, that has an overhead multiplier that will take time to train. And if you leave it to the last minute, you'll have to pay big bucks to hire someone who's done it before, maybe for a different company, instead of starting with a longer time horizon, understanding which deals, which you'll see a lot, we've been explaining here, how many tenders you have to apply that now ask for an ESG data point, what's the average tender value, and how many of those you can win over time, and putting all of those things together to build the ROI case for a CFO, for the board, whenever you have to find budgets to use compliance as business acceleration or really to understand where to get started. And these numbers are not being overly estimated. They've been released by the government in Australia when they first did the modeling of the true cost of disclosure. And Group 1 companies are paying up to $1.2 million in the first year of disclosure. So there's a real cost to this. We believe it's going to be lower as new reports are going to come out and you can draw some inspiration, but just be aware that this is not going to be just some easy check. At the end of the day, you need to spend time building these systems for your auditors to understand. We'll share all those resources for you to play around and add the inputs. But like was said in this presentation, it will take some time, and it's about building that collaboration over a period of time instead of leaving to the last minute and trying to get it done. Hope that is a good summary of where we are in terms of integrating technology and consultancy together to deliver real value in business acceleration for our clients.
Thanks. I might jump in here, Afonso. I'm really interested to hear from your perspective, noting we just have a couple of minutes, but you're on the ground in Australia across multiple countries, talking to businesses at all ends of the spectrum. Obviously, the group and the reporting thresholds and everything is changing rapidly, and the future beyond Group 3 is quite interesting. But what are the conversations with businesses like, and how have they changed over the last even 6 and 12 months? What have you noticed in that space?
Well, a big thing was hesitation in terms of deploying any budget because they were still hoping of like happening in Europe with the rollback of legislation that the same thing will happen in Australia. It didn't happen, so it's here. So CFOs and board members were waiting on deploying the capital, and now because it's happening, we actually have board members that are learning from one company to the other because they're sitting across different companies, and we see a lot of like knowledge sharing. So it went from will this going to happen to I see another company doing it better. I want this company to do the same thing. Because the ambition level in terms of like comparing one to the other is actually increasing. So people don't want to be the worst at climate reporting. They actually want to make good commitments, show good strategies, and they're being a bit more jealous about how others are performing comparing to their own work.
And I imagine that stop-start delay in that decision making of investing and looking at really institutionalizing a process has probably put a lot of businesses on the back foot, right? And now is probably the time to act increasingly so. I mean, anecdotally, from what we're seeing amongst our clients is, we look at the ESG market and we think largely that this is for large entities, but it affects the whole end-to-end spectrum of that life cycle of business, including the supply chain. So if you're a smaller business out there, and you are supplying an ESG compliant company and you haven't been asked for scope 3 data, that is coming. So not only do you have a compliance risk in Australia with ASIC, but you also have a commercial risk in your business, whether you are a supplier or a large entity that relies on a supply chain. So looking at that seriously is probably a very strategic advantage you could be implementing in your business immediately.
Yeah.
Well, thank you very
Most
much,
definitely.
everybody, for joining us. And thank you very much, Afonso and NetNada, for taking us through the ROI calculator and adding their thoughts to this piece. It wouldn't have been possible to bring this together without you. As a closing remark, if you're in Sydney next week on the 17th of March at our office, we're hosting an in-house event that discusses on a deeper level this whole conversation. You get to rub shoulders with businesses that are living and breathing it and about to embark on the journey for the first time as well. To Namrata's point before, you are not alone, and we at InCorp, Ascentium, and NetNada are here to help you embark on this next business journey that you need to undertake. So thank you very much for joining us today. I appreciate you taking time out of your lunch, and we'll see you next time.